General Ledger Accounting Management System. Overview. General ledger accounting encompasses a number of functional areas. These areas are briefly described below and further explained in the remaining sections of this guide. General ledger accounting. General ledger accounting involves defining the chart of accounts which will enable financial statement preparation to meet both internal and external reporting needs. The chart of accounts consists of asset, liability, equity, budgetary, nominal and memo accounts. The chart of accounts is defined in NSF_GL_app through the Controller General Ledger Accounts. When entering transactions into the accounting system, users must be aware of the impact of the T-code entered and the related general ledger accounts used to classify financial activity. Recording journal entries. Journal entries are frequently required to adjust financial balances as a result of audit adjustments or errors encountered when entering transactions with incorrect classification elements. Users must understand the cause and effect of the required journal entries in order to correctly adjust the financial data. What is the general ledger and chart of accounts? The general ledger, GL, is the bookkeeping system used to record the financial transactions an agency or organization conducts. It is on the GL that all accounting/financial entries are found, and that information is used to create financial statements. The chart of accounts is a list of all accounts used to record financial position and activity in the GL grant financial management. Requirement. DOJ requires that a chart of accounts be established and consistently updated so that all accounts in the accounting system are clearly identified for all programs. This includes accounts to record unallowable costs that are not covered by the federal portion of the award. The GL must be organized, clear, and able to encompass and account for all activities with a financial impact in the organization while providing consistent compliance with generally acceptable accounting principles. Important information to know: what are the 5 main categories of accounts? The 5 main categories of accounts are: assets, resources that will provide a future benefit; liabilities, obligations and responsibilities an organization has incurred, but not yet paid; net assets the organization holds after deducting all liabilities, they are referred to as funds, and can be classified as restricted or non-restricted; revenues, funds coming into the organization; expenses, activities and services conducted that reduce funds. Assets, liabilities, and net assets make up the statement of financial position, balance sheet, and revenues and expenses make up the statement of financial activity, income statement. The specific accounts that make up each one is found in the chart of accounts. Where does the information found on the GL come from? The information found on the GL comes from the daily operation of the organization, which is usually recorded in subledgers such as payroll, purchases, sales, etc., and posted to one or more of the 5 main categories of accounts. How this applies to your grant. The accounts listed below are typical award accounts under each category. DOJ encourages the use of a 5-digit system for each category to ensure there are sufficient individual identification numbers to accommodate existing and newly added accounts. Assets, liabilities, net assets, revenues, expenses. Grouping accounts. Although the chart of accounts is particular to each organization, DOJ recommends the following segmentation. Current assets. Property, plant, and equipment. Current liabilities. Operating revenues. There are instances where organizations may want to add account groups beyond the 5-digit spectrum. How GL categories feed into the balance sheet and income statement. Balance sheets. In general ledger, balance sheet are processed from assets. Reflect resources owned or controlled by company. Produce feature benefit. This will include Asterisk cash. Asterisk account receivable. Asterisk equipment. Asterisk inventory and supplies. Liabilities. Asterisk reflect the obligations not yet paid off by the company. Asterisk have expired a benefit. This will include asterisk account payable. Asterisk short-term debt such as small credit loans. Asterisk long-term debt such as mortgages. Asterisk accrued liabilities such wages and interest. Net assets. Asterisk reflect the overall net worth of the company. Asterisk are calculated by formula assets, minus, liabilities. This will include asterisk temporary restricted funds. Asterisk permanently restricted funds. Asterisk unrestricted funds. Income statement. In general ledger income statement are processed from revenues. Asterisk reflect the influx of income from the company operation. Asterisk have been or will be received. This will include asterisk grants. Asterisk contribution. Asterisk learned income from interest. Expenses. Asterisk reflect the cost of company assumed to produce revenue. Asterisk have been incurred and paid, or incurred and not paid. This will include asterisk rents. Asterisk utilities. Asterisk wages. This happens when the count and complexity of the transactions is high, and subgroups are created to differentiate even further from the standard 5 categories. For example, an organization may use the 40,000s for revenue from contributions, the 50,000s for earned revenue, and the 60,000s for other income from non-operating activities, all of which are revenues. You can find a detailed example of a full chart of accounts for not-for-profit organizations here. Additional considerations. There are times when an organization may have to separate the financial position and activity of their operations. One example is when an organization has multiple grants. Although the activities for each grant will fall under the same 5 categories of accounts, they must be tracked separately in order to report individually on each grant. This separation is done by functional expense allocation. The most typical way of individually allocating is through fund accounting for each grant. An organization with multiple grants, for example, could assign a specific fund account to each one, for example, 4,444 for its university grant and 8,888 for its government grant. When recording an activity, staff would then record the corresponding fund account for each, before the account number. Thus, if the organization received a disbursement from the university, staff would enter 4,444 to 10,000 to record cash in the ledger. If the disbursement came from the government grant, staff would enter 8,888 to 10,000. Ledger accounts and the division of the ledger. In most business entities, each class of transaction and their associated assets and liabilities are given their own account. For example, there will be separate accounts for sales, purchases, rent, liabilities to pay suppliers, payables, amounts due from customers, receivables, etc. There is no rule as to how many accounts an entity should have, but the system should facilitate effective and efficient accounting and control. Each account in the system is referred to as a ledger. In simple terms, the ledger accounts are where the double entry records of all transactions and events are made. They are the principal books or files for recording and totaling monetary transactions by account. An entity's financial statements are generated from summary totals in the ledgers. The term nominal ledger or general ledger is used to refer to the overall system of ledger accounts used within an entity. It houses all the separate ledgers required to produce a complete trial balance and, consequently, set of financial statements. As stated above, each class of transaction, asset, liability, and item of equity will have its own ledger account. The summary of these Ledger balances will eventually be transferred into the corresponding caption in the primary financial statements. For a summary of the main classifications, please refer to the earlier chapters which explain the elements of the financial statements and the classification of assets, liabilities, capital, income, and expense in a set of financial statements. Note also that books of prime entry were covered in more detail in an earlier chapter. In this chapter we will focus on the entries made in the ledger accounts. In particular, we will look at the nature of double entry bookkeeping, duality, double entry, and the accounting equation. Each transaction that an entity enters into affects the financial statements in two ways. For example, an entity may buy a vehicle for cash. The two effects on the entity are: 1. It has increased the vehicle assets it has at its disposal for generating income, and 2. There is a decrease in cash available to the entity. To follow the rules of double entry bookkeeping, each time a transaction is recorded, both effects must be taken into account. These two effects are equal and opposite, and, as such, the accounting equation will always be maintained. The accounting equation asset equals equity, liabilities. Asset, equity equals liabilities. Note that the image above used the term equity, which is an alternative term to capital when dealing with the accounting equation. The statement of financial position shows the position of an entity at one point in time. A statement of financial position will always satisfy the accounting equation as shown above. The accounting equation is a simple expression of the fact that at any point in time the assets of the entity will be equal to its liabilities plus its equity. Ledger accounts, debits and credits. An account is a record of the transactions involving a particular item. A ledger account may be thought of as a record kept as a page in a book. The book contains many pages, many accounts, and is referred to as a ledger. In this chapter we are concerned with the nominal ledger, which is the ledger containing all of the accounts necessary to summarize an entity's transactions and prepare a statement of financial position and statement of profit or loss. Each account comprises two sides. The left-hand side is referred to as the debit side, and the right-hand side is referred to as the credit side. Summary of steps to record a transaction: debit, D, credit, K. 1. Identify the items that are affected. 2. Consider whether they are being increased or decreased. 3. Decide whether each account should be debited or credited. 4. Check that a debit entry and a credit entry have been made and they are both for the same amount. Transactions and events are eventually recorded in the relevant ledger accounts using a double entry to reflect the duality concept. Explained previously. There is a ledger account for each asset, liability, equity, income, and expense item. Traditionally, each account was drawn as an enlarged T that has two sides, a debit and a credit side as illustrated. The duality concept means that each transaction will affect at least two ledger accounts. One account will be debited and the other credited. Whether an entry is to the debit or credit side of an account depends on the type of account and the transaction. What is a ledger account? A ledger account is a record of the transactions involving a particular item. A ledger account may be thought of as a record kept as a page in a book. The book contains many pages, many accounts, and is referred to as a ledger. In this chapter we are concerned with the nominal ledger, which is the ledger containing all of the accounts necessary to summarize an entity's transactions and prepare a statement of financial position and statement of profit or loss. Each account comprises two sides. The left-hand side is referred to as the debit side, and the right-hand side is referred to as the credit side. What is double entry bookkeeping? According to the CIMA official terminology, double entry bookkeeping, the most commonly used system of bookkeeping based on the principle that every financial transaction involves the simultaneous receiving and giving of value, and is therefore recorded twice. Duality concept. Earlier in this text we saw how some transactions affected the accounting equation and the statement of financial position. We saw that each transaction had two effects. This is referred to as the dual aspect or duality concept. For example, receiving payment from a receivable increases the asset cash, whilst also reducing the asset receivables. Paying a supplier reduces the asset cash whilst also reducing the liability payables. In both cases, the accounting equation remains intact. The fact that every transaction has two effects, equal and opposite, means that each transaction must be recorded in two ledger accounts. This is double entry bookkeeping. Bookkeeping is the technique of recording financial transactions as they occur so that summaries may be made of the transactions and presented as a report to the users of accounts. The double entry bookkeeping technique applies to the recording of transactions in ledger accounts. In the previous chapters, you were introduced to the following terms: assets, liabilities, capital/equity, income, and expenses. These 5 items can be put into 2 categories, according to whether they appear in the statement of financial position or in the statement of profit or loss. If you compare these pairs, you will see that they are, in effect, 2 pairs of opposites. Each type of asset, liability, capital, expense, or income is recorded separately. This is achieved by using separate ledger accounts for each of them. Assets, liabilities, and capital appear on the statement of financial position. Expenses and revenue appear in the statement of profit or loss. 7 bookkeeping entries for the statement of financial position. We shall look first of all at recording assets, liabilities, and capital. Transactions are recorded on either the debit or the credit side of a ledger account. Debit, D. Asterisk increases in assets. Asterisk decreases in liabilities. Asterisk decreases in capital. Credit, K. Asterisk decreases in assets. Asterisk increases liabilities. Asterisk increases in capital/equity. Examples of debit and credit entries. Examples of debit entries: increase in assets, e.g. purchase of inventory, non-current assets, increase in cash/bank. Decreases in liabilities, e.g. payment of suppliers/loans. Decreases in capital, e.g. drawings. Examples of credit entries: decrease in assets, e.g. sale of non-current assets, payment of receivables, decreases in cash/bank. Increases in liabilities, e.g. purchase of goods on credit, new loans obtained. Increase in capital, e.g. introduce new capital into the entity. Bookkeeping entries for expenses and income. An expense is a cost connected with the day-to-day activities of the entity. Examples of expenses include rent, local business tax, light and heat, wages and salaries, postage, telephone, i.e. costs of operating the business entity, along with the cost of items bought for resale. Income is the term used to describe the activities that will eventually lead to the entity receiving money. The most common source of income is that derived from the sale of its goods or services, but others include the receipt of interest on bank deposits. Transactions are recorded on either the debit or the credit side of a ledger account according to the following table. Debit, D. Asterisk increases in expenses. Asterisk decreases in income. Credit, K. Asterisk decreases in expenses. Asterisk increases in income. Examples of debit and credit entries. Examples of debit entries: increases in expenses, e.g. purchase of materials, rent, wages, electricity costs. Decreases in income, e.g. sales returns. Examples of credit entries: increases in expenses, e.g. purchase of materials, rent, wages, electricity costs. Decreases in income, e.g. sales returns. Decreases in expenses, e.g. purchase returns. Increases in income, e.g. sales of goods for cash or credit. General ledger accounting application modules. Administrator. Asterisk user properties. Asterisk user logs. Asterisk app license. Master data. Asterisk chart account. Asterisk office branch. Asterisk department. Asterisk journal. Asterisk currency. Asterisk elimination. Asterisk budget. Asterisk priority or system. Asterisk format reports balance. Asterisk format reports profit loss. Asterisk format reports equity. Asterisk format reports others. Asterisk country. Asterisk city district. Asterisk cost control. Transaction. Asterisk journal. Asterisk link GL. Process. Asterisk process posting. Asterisk process revaluation. Asterisk process unpost. Auto journal. Asterisk table auto journal. Asterisk process auto journal. Utility. Asterisk delete data. Asterisk setting book year. Reports. Asterisk recap main book. Asterisk main book. Asterisk balance. Asterisk income statement. Asterisk cost control. Asterisk equity changes. Asterisk others. Messaging. Asterisk inbox. Asterisk outbox. Asterisk draft. Your account. Asterisk change password. Asterisk change photo. Asterisk change language. Asterisk log history. Receivable accounting system. Abstract. The accounts receivable term represents the funds that a company had not yet collected for the services/products that were already provided purchasing party. Such kind of services are sold on credit, and the fund collection is the task that should be properly realized, i.e. the management of accounts receivable should be accomplished. Usually companies negotiate all conditions of the payment processes and conduct them in the mutual contracts as per which the accounts receivable management is realized. However, the accounts receivable management itself may not be considered as a simple fund collection, and it covers a much complex line of processes. Each company has to make a certain collection plan that depends on number of factors, and considers various techniques that help the company make the correct decisions and actions for achievement of targets. Certain part of such decision-making falls on different company departments that are not directly connected to accounting, such as marketing and sales departments, which gives additional value to their performance as well. Introduction. The details and full plan of accounts receivable management is the matter of decision-making for each company and totally depends on the type of activities and corporate management of the corresponding company. However, there are various commonly used techniques that are applied by the companies in order to have a well-functioning accounts receivable processes. This article would show the sampling technique that is commonly used among accountants as one of the methods for determining the accounts receivable plan. However, as part of accounting principles, the companies are strongly urged to use and apply several accounts receivable technique at the same time for the better view of situation. Below we may see the best no accounts receivable management techniques. Ratio analysis. O accounts receivables turnover ratio. O days receivables ratio. Budgeting. Customer profiling. Statistical types of analysis. O regression type analysis. O ANOVA type analysis. O cluster type analysis. O correlation type analysis. O sampling. Accounts receivable aging. Out of above mentioned accounts receivable techniques, this article will reflect the aspects of sampling technique, its application, strong and weak points, best usage advises. Accounts receivable management. Accounts receivable management considers all proper and necessary steps that the accounting department and a company in overall should take for the purpose of managing the fund collections, that would create a complex balance between covering the needs of the company and keeping the clients motivated and satisfied. Respectively, the bigger a company is, the harder accounts receivable management process becomes to them. However, this matter is important for any kind of the companies that provides any kind of services/goods on credit sale conditions. Below we may see the core cycle of accounts receivable management processes. Step 1, Business Partner Maintenance. This step considers the collection and coordination of all necessary information regarding each client to which the services/goods are provided on credit sales. On the background of this process lies the performance of marketing and sales departments as well. Step 2, Billing and Invoice Printing. This step considers the data input regarding each invoice issued for each client as per the services/goods provided to the corresponding client. Also, this step represents the physical issuing of the invoices and billing to the clients on timely basis. The conditions of invoice billing and delivering has to be reflected in contract terms. Step 3, Credit Memo Processing. This step considers all communication steps between the client and service/goods provider in order to obtain the most optimal way of accounts receivable realization and solution. By realizing this step, the accounting department consider communicating with the client side and notifying about the payment due and conditions. The methods of credit memo processing include such documents as credit memo document, IOU notes, follow-up emails, official letters, and others. Respectively, all conditions and dues dates are mentioned in the contacts and should be reflected in the invoices correspondingly. Step 4, Aging/dunning. At this step the company takes all reasonable and needed action for the analyzing the information that they have, which includes main below units. 1. Amount received. 2. Total amount awaited. 3. Amount promised to be covered. 4. Minimum needed amount as per the planning. Once the company has a clear view of the situation, i.e. all amount that they actually received till that point of time and what should be collected, it takes further steps with purpose to collect the rest needed funds. As shown in previous unit, the company would be using all needed communication actions in order to collect the needed funds. Step 5, Payment. At this stage the company account department takes care of the payments that the client companies realize and allocates them as per personal accounts of each client and covers the outstanding invoices, confirming the realization of accounts receivable in refer to the corresponding case. This step also considers the correct management and collection of the bank information as the proof of the paid funds. The correct allocation is a very sensitive process and should be committed with high accuracy, so that the actually paid invoices and still outstanding invoices are divided and not mixed among each other. This step is very critical for further fund collection and may not undervalued. Step 6, Recover or write off. Once the company finalizes its allocation process, it has the clear view of all invoices that still are counted as outstanding ones, i.e. the ones that are still needed to be followed and collected. After the analysis of all paid invoice, i.e. covered funds, the company has to make another analysis of the data and decide whether invoice is up to further evaluation and follow-up or it does not have any chance for covering. In other words, the company would have to decide to which below category the invoice is applicable. A. Recovery. B. Write-off. The recovery category stands for the invoices that need to be further worked on and have a chance for recovering, i.e. collection by the company from the clients. While write-off category stands for the invoices that are counted to be a bad debt, i.e. would not be collected under any circumstances, which is counted as pure loss for the company. Respectively, the company target is to avoid the write-off category as much as possible and to have invoices paid fully and in time. Step 7, Receipt Processing. At this stage the company accounting department makes another analysis of overall funds received for the certain period and applies the accounts receivable management techniques in order to have a full view of what was collected with what age, what rate of the issued invoices, and to find out the weak and strong points of the company. This analysis also shows the payment attitude of the clients, so that company would be able to decide on how it should treat its clients and what kind of actions should applied for covering the gaps within the company. Accounts receivable management principles. As a main part of accounts receivable management, the company has to determine certain principles and act per those principles that would make the company ensure the correct management of collection processes. Below we may see the principles of accounts receivable management. 1. Client determination. 2. Establishment of a payment period. 3. Monitoring the collections. 4. Evaluation of the receivables balance. 5. Acceleration of cash receipts from receivables. Client determination stand for the choosing of the clients that the service/goods providing company wishes to see as client with credit sales option. In other words, besides the client that chooses the service/goods providing company, there is always a choice on the side of the contractor if it agrees to provide certain service or goods on credit sales. As we know, the credit sales always considers certain risk of losing funds if the accounting team fails to collect those funds. Respectively, it is very important to have a certain client research actions beforehand and determine if the particular client is reliable enough to provide the services/goods that party on credit sales. Establishment of a payment period is also very sensitive process for the company, as the payment due allowance period plays one of the main roles in such matter as payment aging, the age of invoices at their payment point. As we know, each company has to make its own decision what kind of payment allowance frame it want to set for the clients, and such kind of decision depends on certain criteria. Below we may see the criteria that influence the decision making of payment allowance that is settled by the service/goods providing side. 1. The potential receivable revenue for the client. 2. The reputation of the client. 3. The mutual history with the client company. 4. The financial situation of the company, contractor. The payment allowance period is a matter that should be communicated and agreed by both the client and contractor sides, respectively mentioned with details in contract and reflected in each issued invoice to the corresponding client. In below table, we may see the applicable algorithm of the proper steps for establishment and realization of main credit terms. Establishing credit terms. Once a firm decides what its credit terms is, it has to establish below units as well. O. The payment allowance period, net days mentioned as period. O. If the discount should be applied, if the discount is decided, the rate should be determined. O. If the company is quite small, if would probably settle softer credit payment terms. Monitoring of the collections is the principle that urges the companies make all necessary steps to build up a strong and stable system that would monitor the data that company has and be able to come up with certain outcomes. In other words, as per the principle, the company has to mine any information it gets from working process with purpose to realize and develop the proper accounts receivable management. The monitoring principle also urges the companies to determine a well-structured communication attitude with the client companies that would provide them the needed information for usage. Besides that, this principle states that the company should be able to make proper analysis and use it for its own benefit without abusing the ethics and the accounting principles, which are very important for both the company and the market in general. Evaluation of the receivables balance is the principle that represents the analysis of the information as per issued invoices and determining the need of what should be collected, for what period, when and how much. As per the principle, each Company needs to make below 2 arrangement for each corresponding period, and a financial year correspondingly at the end of each period. Below we may see these 2 arrangements. Amount to be received. Amount under the risk to be not received, dubious. Amount to be received arrangement respectfully divides on 2 kinds as per below. The one which is done for each next period/month. The one which is done for each next financial year. In the calculations, the accountant responsible for collection of accounts receivable would not need to determine the probability percentage for each end. Every invoice, the employee would only mention the details of invoices that planned to be paid as per the objective analysis. Below we may see the main targets of the objective analysis. 1. Promised arrangement of payment by client, with approximate payment date, which was notified either orally or in written. 2. The attitude of the client, which is counted to be a systematic behavior. As per precedent. Example, some client companies notify their contractors that their company makes payment on certain dates of the months and the contactor already knows when to await the payments. This does not mean that the invoice would be surely paid, but once the companies have good communication skills, they may have arrangements that gives a big chance for the payment in promised time. 3. Technical issues that may delay the payment. Sometime the wire transfers of paid debts may last up till 1 week, if the transfer is international, depending on the countries of transferring sides. In such cases the payer, client company, may have already made the payment for debt, but the payee, provider, company, would receive it in the time that would fall on the next period. It may also include check payments, that is sent via postage and would be delivered in certain time. Acceleration of cash receipts from receivables principle states that making all reasonably needed actions with purpose of gaining the collections in soonest time after the invoice is issued, is the contractor's, i.e. service/goods provider, company's top target and task. Below we can view 2 main reasons that represent the above-mentioned principle. 1. Each day of waiting bring up to the decrease of money time value with respectively makes the company dare to collect the funds in the soonest future. 2. Companies consider that is risky to wait for the payment of certain invoice, and it should make all actions in order to get them now, and even if they have to make a certain discount for it, it is acceptable and considered as benefiting the company, correspondingly considering the reasonable amount to be discounted. Reasonably, there are various kinds of actions that the company can apply in order to fulfill the principle. Below we may see the 2 types of the mentioned actions that may be taken for realization of this principle. 1. Discounting. 2. Accounts receivable financing. Discounting is the method that then contractor companies use referring to their clients in order to obtain the speed up in collection processes. On other words, the company makes certain discount to the clients for the payment that is done within certain period of time, which is shorter than the payment allowance period. This method is widely used among the companies, and such S= condition should be clearly reflected in the issue's invoices. Accounts receivable financing is a more complex method that is used by companies toward their clients in more risky situations, when the service/goods providing company cannot succeed in receiving the payment. In such situations, some of the companies ask for the assistance of some legal assistance companies and sell them the debt of the client company for less amount that the debt itself is. As result of it, the contractor company gets the funds saved from bad debt at least partially, and the legal company deals directly with the client company. Usually, the legal companies take all legal actions in order to get the funds. From the other side, the contractor company would definitely terminate the contract with the corresponding client. Respectively, all needed documents and authorizations are exchanged between the contractor and legal companies. The main purpose of accounts receivable management principles is to provide correct core instructions of how the company should manage its collections, as this task is considered as one of the most tricky and risky processes in the company that is the responsibility of accounting department. The principles of accounts receivable management consider the benefits of the service/goods providing side, however. It does not exclude all other accounting standards and the ethics in general, which should always be applied and followed by all type of companies. Sampling technique. Sampling technique is a statistical method of data analysis that estimates the attitude of whole group of units, clients in our case, as per the sample results of only several of such units. This technique is widely used by the accounts receivable controller while they try to determine an overall situation in the company. Such kind of method is more applicable in big companies than in smaller ones, due to the big load of information, where a company has a great number of clients, respectively, with greater number of invoices issues to them, and it is inapplicable to analyze each single invoice and the information about it manually. Due to this, the accounts receivable controller uses the sampling technique, that may not show him/her the exact information about each client, but it would definitely let the employee know if there is a signal for warning and if the clients are mistreating their contractor and the contract condition and terms. Sampling technique is mainly used with the aging information for each invoice that the company issued and tried to collect. This technique may be used with unpaid invoices either, however, as per the world practice it is less recommended. The sampling technique may be easily applied in Excel program as well, which makes it easy for usage. Conclusion. Despite the fact that accounts receivable management is quite a complex time-consuming and difficult task, its proper management has its own ways of solutions which gives positive results to the company overall. The realization of solutions on the way to the accounts receivable management is considered as one the main priorities of the company, and its mistreatment would bring up to the failure of financial tasks. Each company must make its own decision on what kind of accounts receivable management system they want to apply and how the company should treat the clients on the way to reaching the targets. Meanwhile, the companies should also remember that they cannot target collecting all funds at once and from everyone, and due to this should be able to build up a plan of actions for each period and determine what their prior targets are, which would make it easier for the team to concentrate and manage the collection process. As per the review shown above, we could observe how the accounts receivable management works and what kind of technique is one of the most commonly used among accounts receivable controller, their reasons, and the main advantages of such approach. However, despite the technique choosing, the accounts receivable controller should always keep in mind the principles of accounts receivable management, what their true meaning is and how they instruct the accountants to manage the fund collection. Receivable accounting modules. Admin. * user properties. * user logs. * app license. Master data. * customer. * sales. * area. * currency. * numbering. * parameter system. * country. * city district. Transaction. * receivable. * receivable correction. * receivable payment. Process. * process transaction. Link GL. * table AR link GL. * trans AR link GL. Utility. * delete data. Reports. * receivable mutation. * receivable card. * receivable period. * summary receivable per month. * summary receivable per GL. * list of invoice. * invoice letter. Messaging. Asterisk inbox. Asterisk outbox. Asterisk draft. Your account. Asterisk change password. Asterisk change photo. Asterisk change language. Asterisk log history.